everybody. My name is Jeff Lerman. Welcome to today's webinar, Annual Report on Real Estate Joint Venture Equity Partnerships Formed and Proposed in 2011. My name is Jeff Lerman. I am a featured expert on TV, radio, and newspapers. I am past president of the Marin County Bar Association. I am the real estate investor's lawyer. Rated AV, which is the highest possible rating by Martindale-Hubbell, 10 out of 10 on AVO, past chair of the California State Bar Real Estate Litigation Section, past chair of the Marin County Bar Real Property Section, general counsel for 2 national real estate syndication companies, lecturer at the UC Berkeley Fisher Center of Real Estate and the USC Law Center. Been doing this for 30 years. I am a real estate investor as well. Today's talk is going to feature Bruce Kirsch, and we're going to introduce Bruce in a moment. Just want to give you a quick little preview as to why I thought this was a presentation that you would be interested in. This seminar is going to answer the key question: how are deals actually getting done in this economy? You know, there are so many investors who may find these great deals, and then they need a joint venture partner to close the deal. But because they don't know what structures are most popular, which structures are most likely to result in the joint venture partner actually wanting to go into your deal, they end up not being able to close those deals. And when they can't close the deals, then they can lose out on all their potential profits, which can sometimes be millions of dollars. So what this tool, what this strategy, what this particular product that Bruce is going to talk to you about can do is make all the difference in whether or not you can get your deals done, get your joint ventures done. And when I saw this study, I thought it was unique in that I had not seen something that really basically pulled aside the curtain and let you look into and over the shoulder of the deal structures of these private joint commendable that Bruce had put in this kind of effort into assembling this information, put it into a format that I thought was very well organized and detailed. And it's something I wanted to share with you and thought you'd be interested in, because we're all actually interested in the same thing, which is getting more deals done, especially in this, what I believe to be the best buyer's market that we're ever going to see for the rest of our lives. So without further ado, let me introduce you to Bruce. Bruce founded this company, Real Estate Financial Modeling, in 2009, which is a solutions provider for financial analysis, financial modeling training, and data for commercial real estate transactions. Bruce is the editor of the 3rd edition of Wharton Professor Peter Linneman's Real Estate Finance and Investments, Risks and Opportunities, which is the leading real estate finance textbook. Bruce instructs on real estate finance and financial modeling as an adjunct faculty member at Georgetown University. He is a highly acclaimed financial modeling trainer. Bruce previously worked in commercial brokerage and real estate investment in New York and Washington, D.C. Bruce holds an MBA in real estate from the Wharton School and a BA in communication from Stanford University. Bruce, can you hear me?
Hi, how is everybody?
So Bruce, I'm going to let you take control of the presentation, and then throughout the course I may interject a question or two just to try to elaborate on a few things, but it's your show.
Okay, great. Thank you so much, Jeff, for giving me this opportunity to speak with your group. Pleasure to meet you all over the internet. I'm Bruce Kirsch. I'm the founder of Real Estate Financial Modeling. We're in our 3rd year of business. We offer everything that you see here on your screen, and we have clients that range from some of the very largest players in the global real estate industry, such as the Abu Dhabi Investment Authority and Vornado Realty Trust, and so on. And we also work directly with small and medium-sized developers and investors and other stakeholders in real estate transactions. The genesis of this Real Deals database came out of my working with my consulting clients when they would ask me, in discussing the technical workings of waterfall structures for profit partitioning, what is a reasonable transaction structure for, let's say, a $15 million light industrial deal in Central Florida? And while I see a lot of transactions, I definitely don't see them all, and nobody does. So I started thinking to myself, and it always starts out innocently enough, I said, gee, you know, I wonder if I put this data together, figured out some way to reliably collect it and then organize it and make it searchable, if this would be valuable to the marketplace. And so luckily I'm an entrepreneur and I get to play around with my hunches a little bit. So I said, you know what, I think this one is worth floating out there. And so this was about a year ago, and I put together a 112-question survey and offered the survey to the thousands of account holders at my website and started to get back these transaction structures. And I personally filled out the survey with about 24 of the survey respondents. And so basically, it all starts out very innocently, but now what we have is a database, the first and only one of its kind, that houses 24 transaction structures comprising $400 million in total equity investment. Okay? And so this is amazing. This is something that has been a very murky part of the business where nobody has ever bothered to shine any light. These are the types of tidbits of information that typically you would only get on the golf course or over cocktails. And the problem with those methods is that A, our memories can be hazy, and B, sometimes we don't ask all the questions that we need to ask. And quite frankly, the devil really is in the details in these structures. A simple and in the place of or can mean millions of dollars in profit partitioning. So we really do need to be very careful and very granular in our understanding of these things. And so basically, we now have this as a new resource to us in the development and investment community where we can study these structures, okay, gain insights from them, look for trends, and hopefully it'll give us some incremental edge in our negotiations such that we can do a little bit better this next time than maybe we did the last time. Okay, so today what we're going to talk about is very briefly, since I know this is a highly sophisticated audience, the background on the rationale for seeking a partner, what are the risks, and theoretically, what is the optimal way to structure a joint venture transaction. We'll talk about how the Real Deals database is successful in standardizing the very important and sometimes vague nomenclature of the technical terminology such as preferred returns and promotes and so on and so forth. Then we'll get right into it, look at the actual 19 transaction structures that were put in place in 2011 and talk about what I think are the surprises that we see in the data. And lastly, we'll talk about how the database and the annual report that we've just published as of today can benefit you going forward. Okay, so very quickly, and I think I went forward one too many. There we go. Why does one seek a joint venture partner? Well, as a sponsor, you need capital. Usually pretty simple. There are some additional benefits as a sponsor to having a third-party investor on your team. You can get better access to lenders. You have increased credibility. Sometimes you can benefit from better pricing from a service provider, such as a maintenance company or a security company. And lastly, you'll benefit from the wisdom and the expertise of that investor. Okay? As the investor, it's a little bit more simple. Okay? Capital is looking for returns. Capital chases performance. End of story. So what investors are looking for is simply a vehicle. It might be a development, it might be an existing income-producing property, or a mortgage note. Okay? And so what are the risks that both sponsor and investor are taking when they engage in a transaction? Okay, the sponsor is responsible for going out, securing, and controlling an opportunity. And so the funds that they put out, the man hours, the bandwidth, the overhead that they commit to pursuing and controlling an opportunity, those are the riskiest funds, and you can never get those back. Okay, so the sponsor bears that risk. Then the question becomes, once they have secured an opportunity, polished it up, packaged it, and brought it over to equity, and they're at the point where they are negotiating a potential joint venture, how are these other financial risks going to be apportioned? Okay? Who's going to bear the responsibility, the liability for construction budget shortfalls? What about operating deficits? Who's going to guarantee the loans? Okay? We look at all of these things in our survey in detail, and this data set is so rich, it is phenomenal, and it's pretty mind-blowing that we finally have something that we can look at and compare things on an apples-to-apples basis. Naturally, there's always reputational risk as well. Real estate is the most public type of endeavor. It's either you're the hero or you're the villain. Okay, so we want to understand how do people get these structures put together so hopefully they can go out and together be the hero in the community. Okay, so the fundamental question here is, given how much and when cash investment goes into the transaction from each party, and given the unique roles that the parties play, when should the original capital that was invested and the returns on that capital come out of the transaction, and how should it be partitioned to each party? Okay, and so as we go through this presentation, we're gonna use nomenclature that is standardized such that we are always comparing the same thing. And so basically what we're going to say is the sponsor of the transaction we will also refer to as the principal, and that's simply the owner or developer of the asset. And the third-party investor, also known as simply the investor, is going to be a capital provider. Okay? And so the question becomes, between sponsor and third-party investor, is a pro rata or proportional reward in fact desirable from the investor's point of view? If the sponsor goes in at 10% and the investor provides the balance, would in fact the investor want the profit structured such that they would come out with 90% no matter how well or how poorly the transaction did, and the sponsor would get their 10%? Okay, and the answer to that is a resounding no. And the reason for that is that we want the sponsor, who I liken to the pilot of the plane, we want them to be alert, awake, enthusiastic, and intensely focused on the success of the transaction. Okay? And it's pretty easy to incentivize business people. You simply dangle some money out there for them. Okay? And so what we do is we set up a structure that is going to disproportionately reward the sponsor in terms of financial reward relative to the financial risk that they have taken. Okay? And again, the reason for that is the sponsor is the one piloting the plane, and of equal, if not more importance, landing the plane. Okay? The most important part of a plane flight is the landing. Okay, so that's with respect to 2 equity players. We do also have some structures in the database that have 3 equity players. And in this case, what we do is we say, all right, well, let's give a name to the overall sponsor as that entity, that JV entity that will comprise both sponsor or local player and their minority investor or partner. Okay? And so that partnership is going to be the first one that's put in place, and then those 2, as we call them, as the overall sponsor, would then approach a third-party investor to get the balance of the capital. Okay? And so this is essentially how we break up this set of entities such that we can ask these very finely pointed questions in the various sections of the 100-question survey.
Bruce?
Yes.
Let's spend a minute talking about what you just said here, because I think it's an important point that we're seeing. Actually, I'm seeing a lot more frequently in my practice. And if you could maybe go back to that last slide and let's talk about that for a second. Can you go back? Okay. So what you're saying is, let's say that I'm the overall sponsor. I found the deal, and now I'm trying to find money to do the deal. The situation, as I understand it, where what I'm trying to do for everybody's benefit is to distinguish the minority investor from the third-party investor. In
Yes.
your mind, is let's say that we need $1 million capital for the deal. Are you saying that maybe you've got a larger investor who is willing to come up with, say, $500,000, and then you've got 5 smaller investors that are each going to put up $100,000? So is that larger $500,000 the third-party investor, and then each of those 5 $100,000 are the minority investor?
That's exactly right, and I actually have in a couple of slides, I have a graphic which shows this hopefully in a way that will further illuminate it, but you're exactly right, Jeff.
Okay. So I want to underscore this because I was really happy to see that you were including this in here. This is something that I have seen developing in this economy, where you've got this these 2 classes of equity partners out there who are saying, look, I'm interested in your deal, but I don't want the same deal that the smaller guy is getting. If I'm putting up this much money, I want something better. And it's creating this this need for this conversation. And so with that, Bruce, continue, please.
Sure. Thank you. So I'm just going to flip forward now and land on this slide, which dovetails into what we were just talking about. So yes, the third-party investor, we can always think of them as the big money partner. Okay, the sponsor is typically your owner or your developer, the local player. They're going to go and they're the tip of the spear, secure the opportunity. They might have some assistance in the pursuit of controlling the opportunity in the form of a partner, which we also refer to as the minority investor in the nomenclature used in the survey and the database. Okay? So what we show here are, in fact, 2 separate 90-10 structures that are woven together to total the 100% equity amount of $20 million. Okay? And as you said, this partner equity here, this could very well, in fact, be a syndicate that has 10, 20, or 30 different shareholders. Okay?
Okay.
Great. So now the question becomes, all right, well, that's how the money went in. Okay? Well, how can cash flows be commensurate, okay, coming out with both the risk taken and the value added? Okay? And how is it typically structured? Okay, so this is the question that everybody wants to know. Well, unfortunately, there is no typical structure. We have dozens of property types, hundreds of geographies, dozens of transaction types, cultural groups, even within the United States and then naturally all around the world. So we have tens, if not hundreds of thousands of these partnerships out there. Okay, so we would love to be able to say, well, this is how it works, but that is not a luxury that we have. So what we need to do and what we have done with the database is really dig in here and say, all right, let's really understand how these are getting done, and let's put it down on paper and let's make it searchable. Nonetheless, every one of these partnerships is negotiation specific, and they all revolve around the same end goal, which is how do we get this investment entity to be able to navigate all of the risks that we perceive now and those risks that we don't yet see, okay, such that we can strive to have the transaction reach its potential. And the Real Deals database is going to give us these insights, and this is such a terrific, rich data set and unique opportunity to now take a peek into these things, especially if you, let's say, didn't grow up in a real estate family, which many people do not, or you did not grow up hearing these conversations across the dinner table or on the golf course, okay? And so this is an extremely interesting and illuminating way to start to get your head around these things and try to recognize trends and patterns and essentially what's working, okay? What bait is out there that's getting hooked, okay? And so it's going to give us the details for the structures on a variety of actual transactions being put together in the market today. We do the hard part of standardized terminology so there's no vagueness and no misunderstanding, okay? And what we do on the survey submission side is we purposefully disguise the transactions such that if you do a transaction in Arizona, that's simply going to fall into the bucket of the Southwest U.S., okay? And we do that along other lines as well, such that actual players who are doing these transactions have nothing to fear. There's no downside for them, and it encourages the submission of these records on an ongoing basis. And this really, Jeff, is the beauty of the database. This is a living, breathing organism. Okay, I got new structures in yesterday that I actually had to update the report with. Every time a new structure is entered, I review it personally, okay, and I either approve it or reject it. And if it's approved, naturally, it'll be baked into and commingled within the database record set, and it's one more data point that makes the overall set that much more valuable. Okay, so let's talk about the actual transactions reported by market players for 2011, okay? And the survey was brought online in October, so these were all entered over the last 3.5 months. We have 19 actual transactions that in total across both sponsor, minority partner, and third-party investor entities comprise over $150 million in invested equity. Okay, so if you just do the simple math, 150 divided by 19, okay, these are pretty sizable transactions. These are not folks out flipping townhouses. So just wanted to give you a sense of scale and sophistication, okay? And if it's not clear from where I've started with the presentation and the customer base that I have, the folks, the players who are submitting these structures, these are very sophisticated players, okay?
I want to mention something, though, because I know we have a range of people listening here, a range of investors who are doing all, as we've been talking about, all sorts of different deals, product types and sizes of deals. And I have gone through your report, and what I think the value is not only just seeing the information and the specifics of it and all that, but there were also principles, ideas, bargaining points in there that apply or potentially apply to every transaction. And so even though these particular structures that were reported, and I know you were telling me before the call that as part of your methodology and your filtering process, you actually purposely did not include some of the smaller deals. I can tell people, since I represent in my practice a range of investors all the way to from the larger deals down to the smaller deals, the same issues do apply. And in fact, I think some of the structures, a lot of the structures and the findings that the report reveals, I feel are consistent with the same kind of structures that we're seeing at the smaller levels. So I want people who are listening to this and saying, gee, I'm not doing $10 million deals, I'm doing $5 million deals, or I'm doing $2 million deals, or I'm doing $1 million deal. I think that the information that you get from this report is just as helpful and relevant to those deals as well. Go ahead.
Right, and I agree, and you know, I will also say that I think that no matter what size deal a principal or an investor is pursuing now, I can almost guarantee that the next one that they want to do, they want it to be larger. So we're all generally always trending in that direction. It's just a sickness of being a business person. Okay, so let's take a look here at just some of the basics of this. These 19 transactions. We have records that span all of the major geographies in the U.S. Okay. I'm going to just flip through these slides pretty quickly because I want to get to the good stuff. But we do have a diverse array, not only geographically, but also with respect to market type urban transactions, semi-urban transactions, suburban, and so on.
Bruce,
Investment.
I also want to address something else because people might be looking at this, and you said 150 million, but earlier you mentioned that the survey actually represented approximately $400 million worth of transactions. Explain the dichotomy there, what you were referring to.
Sure. So the database in total houses 48 transaction records, 19 actual transactions from 2011, 13 transactions that as of the end of 2011 were in play, and the balance are from 2010 and a handful from years before. So what we're doing not only in collecting actual transaction data points, we are also collecting those that are proposed so that we can see what people are going out there with currently, which I think is equally valuable.
And I think you said in your study you actually segregate these so that people can look at, if they want to just get really focused and try to look for trends, they can compare 2010 to 2011 to those being proposed for 2012, and they can add that layer of analysis if they want to, correct?
That's absolutely right, and that's the beauty and the power of the database is just this constant layering of data points, and over time it's going to become infinitely more valuable because we're going to be able to identify these trends as the real estate cycle moves and the capital cycle moves. So that said, what we are talking about specifically now is the actuals, and that's why it is called out on the title of the slide, just to be clear. And so it spans, as we said, geography, market, investment, and then property type as well. Okay. Naturally, it's a little bit heavily weighted right now towards rental deals, and that's no big surprise. But we do also have actual transactions across the other asset types which are not as hot right now. So one interesting thing just to note is that, okay, as a principal or as an investor, you don't necessarily have to chase the hot property of the day. Okay, other transactions in other asset classes are in fact being consummated. With respect to transaction size, we have in general, okay, more medium to medium large size transactions currently showing in the database, and this is going to change over time. Naturally, when we read the papers, we read about the mega deals, okay, but the meat of the market, quite frankly, is in the medium to the medium large and the medium small band of the spectrum. So really, this is where we want to look if we are in fact playing in that area. And for those who are at the very high end of the institutional range of the spectrum, those deals are going to begin to populate as well. In fact, I'm speaking with a major university's real estate program to assist in pulling in records from those institutional players in a very rapid fashion. With respect to financing, it's interesting to note that the bulk of the transactions here, okay, are above a 60% loan to cost or loan to value. So it is interesting to see that, you know, you don't have to come in with 60% equity as of right now, at least not in these transactions. So that's encouraging, I think, in and of itself. And then we break out on a very granular basis, again, how many equity investors are present in each transaction. And what we note here at the top is that if there is a syndicate involved, okay, we count all of the limited partners in the syndicate as a single entity such that we can fit those transactions into our framework. So the majority of the transactions from actuals in 2011 were, in fact, two equity players. And frankly, I think that's encouraging, that you don't need to go out and find two partners necessarily. You can go out and find just one partner who's going to help you get move the ball down the field.
Bruce, go back to that slide for 1 second. I got a question. So
Sure.
when you're saying if a syndicate, count all the syndicate limited partners as one entity. So if you're seeing you say that 11% were more than 3. So does that mean that could be, if it's more than 3, that means if I'm the sponsor, and let's say I've got my big partner, and then I've got 10 minority partners, now I've got 3 under your terminology in this graph, right?
Yes, you would have 3.
So
now,
if I have more than 3, would that mean that I have a second, maybe I've got 2 larger partners and then several of the smaller investors? Is that what that means?
Right. So it would be you as the principal, perhaps a syndicate, and then also 2 third-party investors, let's say.
And then when it says 2 there, does that also mean that if I am a sponsor and I've just got no majority investor, but I just have, let's say I'm raising again $1 million, and I just got 10 smaller investors, that in your graph I would then have 2 partners. That would be, the number would be 2 there. The 66, the 2/3 of the people fall into that category. Is that correct?
Yes, that is correct.
Got it. Okay, keep going.
Okay. Okay, so now let's take a look at, well, how much is the sponsor putting in typically? Okay, now this is clustering across these 19 transactions at 10%. We did have a handful of 95-5 deals and 3 80-20 deals. Okay, so in fact, there were also some that were 0% or very close to 0% equity from the sponsor side. And so what's interesting about this is you can look at it from the bird's eye view, and in the database, all of these graphs are automatically generated for you when you run your search. So you can first take this bird's eye view, the big picture view, and then what you can do is filter down your search results to say, well, I want to know more about that 0% equity deal. I want to know what the other characteristics, the other elements of that transaction were, such that that's something that I'm looking to do. How did they get it done? Okay, so there's just so much data, there's so much layering and such a wealth of information within every one of the numbers that gets tallied up in this right-hand column here, and that's what makes it really so exciting and valuable. So I'm just, okay. All right, so let's talk about surprise number 1, which I went past by accident. Surprise number 1 in the actual transaction. This is the pro forma, the projected level, or the projected project level equity IRR for these 19 transactions, okay? And what just jumps out at me instantaneously, and what Jeff noted to me, is that, hey, look at all these transactions that were actually getting done at an IRR to the equity holders that's not 20 or 25%, okay? So the encouraging message here is that there are investors out there who are willing to take their capital placed, okay? It sure beats sitting in the ING account 0%. And so this allows us to infer that, well, if I need, in fact, to bid more aggressively in order to win the transaction, then you know what? There are investors out there who are a fit for that. And it's really just a matter at that point of identifying who has that level of interest for a transaction of that nature. Okay. The second surprise here is along the same lines, quite frankly, and it's that not every transaction, not every deal has to double or triple your money. Okay, there are also deals that are getting done at these lower equity multiples. Again, because it sure beats sitting in the ING account at 0%. So again, there are these investors out there who want to make an attractive return, but not an insanely attractive return, given that that risk profile of the investment matches the level of return. Okay, surprise number 3, okay? Look at these fees, guaranteed fees. I made a very serious point of delineating between guaranteed fees, which are non-contingent, not incentive or not performance-based, okay, versus those that are performance-based. This is coming directly from the market players. They're saying that in over half of these transactions, they're able to secure 6, 7-figure guaranteed fees over the life of the transaction. These are not annualized. These are over the life of the transaction in aggregate, okay? And a little bit surprising in that you would think that the sponsors would, right now, in a relatively anemic market, need to accept a little bit less, okay?
Yeah,
but again, these opportunities are out there.
Yeah, I thought this was one of the biggest surprises to me. I believe from the deals that I personally do, where I'm the sponsor, and in the deals that my clients are doing, I speculate, and really, I guess, I speculate that when these aren't necessarily front-loaded fees, as you were saying. These are fees that come out over the course of the time, but having any fees that are guaranteed non-contingent seems like they would be tough sells, and they would be difficult from a marketing standpoint. To see that there are not only these fees that are getting done, but also the different types of fees that are guaranteed, I think is valuable for the people who are listening to this call, because it gives you food for thought. Not saying you have to all of a sudden heap on all these fees on your next deal, but look at those different categories: development, construction management, acquisition, leasing, property management, asset management, disposition. And if you want to put your toe in the water, pick a couple that you feel are most appropriate, where you can where you can communicate the greatest amount of value that you are that your services represent, and try the guaranteed fee. And from what these statistics are showing, they apparently are not getting in the way of closing these deals. And I think this is a huge point that I think the study shows.
Right. I agree completely. And again, the beauty of this is we're just looking at on the aggregate level now. If I want to look into those 6 transactions between $100,000 and $250,000, I have that wealth of information at my fingertips. I can see that one was a ground-up condo deal in the Southeast. Okay. All right. Well, I can look in depth. Well, yes, they guarantee these fees. Well, what did they have to give up, if anything, in order to get those guaranteed fees? Did they also have to exclusively guarantee the loan, for instance? Okay, so we're seeing, again, the aggregate results, but you have the ability to access every detail that underlies these, which is just...
And the other way, by the way, that people can use this information is if for whatever reason you choose not to seek to include a guaranteed fee to you as the sponsor, then use that as part of your marketing. Say, look, I'm not like these other guys who are out there trying to get guaranteed fees. I don't have any front loads. I don't get dime one unless and until you get X out of the deal, and that is what makes this deal better than all these other deals out there. So there are a lot of different ways you can use this information. Go ahead.
Absolutely. I agree completely. And so we also, as I said, took care to tease out which fees were performance-based. So we have all of that as well. So you can see, well, the guy who got $100,000 for the development fee, okay, well, he didn't get anything for the unit sales brokerage, or if he did, then it was exclusively performance-based. So you can look at all of this together. Okay. The fourth surprise is with respect to loan guarantees. Okay. Who's stepping up here to make sure that the preferred financing that is being offered as an option is in fact achieved? And what we're seeing here is that it's not just the sponsors who are stepping up and signing the guarantees. It is sponsors and capital providers. So something, again, to know, and as Jeff just noted, you can play that one of two different ways. Okay. The fifth surprise is, let's talk about return of capital. Okay. This is always the first and most important thing. Is rule number one is don't lose the money, and rule number two is don't forget rule number one. So with respect to return of capital, okay, we would think, just given the environment, that investors would be very firm with respect to getting their capital back on a priority basis. But what we see here is that, you know what, investors are out there and they are in fact fighting for transactions, for the good transactions. Okay, the bad transactions chase capital, and capital chases the good ones. So for the good ones, the investors are out there and they are willing to in fact receive capital back pari passu. Okay, and that's pretty enlightening to me given where we are in the cycle. Okay, we go into detail on the preferred return, the promote structures. It gets quite detailed. There are thousands of data points, and this is one of the reasons why getting the annual report in addition to the database access makes the most sense, because really they do illuminate one another and they add value to one another. They help to organize the information in concert. So we talk about preferred returns and who's getting the preferred return. Okay, this is one of the things that we took a lot of care to tease out. Again, let's not just be vague and talk about it in terms of, yeah, there's a pref, it's an A pref. Okay, well, the next question that I always want to know is who's getting it. Okay, we have all of that data here. It's going to go to both sides. It's going to go just to the investor, and so on.
One of the things that I was surprised about as well, and I'm gonna just tease this point a little bit because I think it's actually one of the biggest surprises and actually also one of the biggest values that I saw in the survey. What I noticed is in the graph where you showed the various prefs, it was interesting that there was one particular number, a percent, that was the most well received by the investing community. And if you went 1% greater or 1% less, if I remember correctly, the difference was four times. In other words, if you know that right number, it was 4 times more popular than 1% more or 1% less. And so if you know that number, then, and if you know what not, it not only improves your chances of getting accepted, but it prevents you from maybe giving too high of a pref, which of course can again translate into a lot of dollars to your bottom line as the sponsor. And I thought that was one of the more valuable findings in the survey, and we're not going to give those numbers here, but of course you'll see those if you get the survey.
Right. It's exactly as my repeat client Barry Metcalf, who's down in Austin, says. Listen, the most important thing is that we're not overreaching. B, we're not ignorant of the opportunities out there, and falling under that category is I want to know what's in fashion, because naturally as the capital pendulum swings, it swings fully both ways. What's currently in fashion, and we want to be apprised of that really detailed information. Okay, and then additionally we go to the topic of who's going to bear the risk for construction shortfalls. Okay, little things that you don't think about on the very front end of a transaction, but can become huge issues down the road and are critical to understand up front. Operating deficit being another example of that.
And by the way, I want people to stay till the very end here because there's a special gift that we're including here to reward those people who really do want to take action on this.
Great. So that's as much as we can fit in. The report, annual report, was released today. It says on the website it's 185 pages. It actually topped out at 205 pages. It's a phenomenal amount of information, nicely organized. There's an executive summary. It comes with an Excel-based pivot table file, which you can use to sort through the records based off of filtering by different criteria. We're offering, good through next Wednesday, a 10% coupon off of access to the database, the annual report, and then also the bundle, which naturally makes the most sense. There's a 20% discount just baked into the bundle. Okay, and the coupon code to use here is Real Deals Web. But really, what the exciting opportunity is if you have knowledge from your own pursuits or that of another player of a valid joint venture structure and you submit it to our database, which can all be done online and takes about 10 minutes if you have the term sheet in front of you, you can get 50% off all of these products, okay? And so the report is $395. Access to the database for 12 months is $495. And the bundle at the 20% discount is $695. And as I said, if you submit a structure that we then approve, and we can generally do it in a day, you can get half off all of those prices that I just referenced, okay? And you can do that. Jeff is going to send out a link that you can use to get to the proper page on the website. I do want to make clear up front that we do have a satisfaction guarantee. Very simple. If you're not satisfied, let me know, okay? All I have in this company, in this business, is my reputation. And if you're not happy, I want to know about it, and I'm going to fix it.
Well, and here's what I'm willing to do to sweeten this off for a little bit. Let's see. What we have also, for the first 10 people who do take advantage of this, is I put together a webinar a couple years back called Partnering for Profit, and we made it into a home study course. And what that does is basically attack this same issue of joint ventures from all the angles that Bruce did not go into. Bruce does, there's a nice fit here, and that was one of the other reasons why I wanted to present this to the group. Bruce attacks it from the number standpoint and what's happening in the real world. But what we look at in this webinar are the tax aspects, the IRA, self-directed IRA investing issues, the business, some of the business issues, and also all the legal aspects. And some of the things that we cover here in this presentation, that home study course that we're offering, is if you get this, you'll learn how to find the right strategic partner to meet your needs, how to convert your properties from problems into profits, how you can use joint ventures to avoid foreclosure, avoid bankruptcy, save your credit, find great investments, invest without worrying about getting financing, invest with bad credit, how you can position yourself for incredible investment returns. What you'll also learn is how to use your self-directed IRA funds to invest with a partner, how to protect yourself from your partner's problems, including potential future bankruptcy. That's a big issue. When you go into business with a partner, quite often it's not somebody that you've done business with before. And even if it is, you need to understand, especially in today's economy, that your partner may have certain issues that you need to protect yourself from. This will teach you how to do that. We'll give you alternative structures for your joint venture, how to minimize partner disputes and stay out of court, how to document your deal. Let's go back to that one for a second. How to minimize partner disputes and stay out of court. We, as a litigator, I deal a lot with partner disputes, especially in today's economy. And if you get in a partner dispute, that can literally cost you hundreds of thousands, if not millions of dollars, depending on the size of the deal. And this is key, and you need to know this if you're going to be doing joint ventures. You'll learn how to document your deal, how to protect yourself from the deadbeat partner, and how to avoid the securities laws completely. This is not a syndication seminar. If you want syndication education, you'll go to our website, and you'll see how to get that information. This will also include a form, memorandum of understanding, that you can use for your next joint venture. That in of itself is worth a fair amount of money, because it's a document that if you came to me and asked me to create for you would cost you several $100s. You can use this MOU, which is the starting point for any joint venture, to help you document your deal preliminarily, and then that will help you understand what your deal is and then move to the more detailed document. A couple of testimonials from people who attended this webinar. The speakers, all well-informed experts in their fields, gave us the outline and steps to take ourselves to a higher plane as investors and as real estate and professionals, to also counsel our clients, friends, families, to empower them to discover new ways to create and share wealth. And Sky Kim out of San Jose said, great, the information is clear, precise, and organized. This presentation, this home study course, is 4.5 hours and had 4 speakers. The cost, if you go to our education website, Investor Education Institute Series at ieisonline.com, you'll see that we charge $147 for that course. However, for those of you who want to take advantage of the special offer, we will include that as a bonus for free for the first 10 people. So in order to take advantage of all the special promotional bonuses, discounts, and offers that you've heard about here, check your email now, and you will see there should be an email there from, I believe, my paralegal, Ina, and there will be a link there. All you got to do is click on the link, and that will take you to the page that you need to go to in order to take advantage of these offers. And if for whatever reason you didn't get the email, or if you're having problems with the link, just go ahead and contact Ina, INNA, at lermanlaw.com. And with that, Bruce, if people have any questions in particular that they would like to ask you, is there a way that you would like to give them to reach you?
Send me an email, give me a call. My email and phone number on the contact and connect with REFM page on my website. My website is get.refm.com, and I'll be happy to address a question.
But don't forget, if you do want to take advantage of all these specials, you need to use the link that we email you in order to make the purchase. You don't want to purchase directly off the REFM website. Otherwise, you will not be getting the benefit of these guarantees and offers. So with that, I thank you all for taking time out of your busy day, joining us, and getting access to this very valuable information. Bruce, I thank you for your time, and we will look forward to seeing all of you on our next event. If you would, I know we have some people on this call today who came in from LinkedIn who are not part of my regular database. I urge you to go to our website, realestateinvestorlaw.com, or Investor Education Institute at ieisonline.com, and sign up to be part of our database. Make sure you're getting our emails for our future information updates and also future webinars. Again, thank you very much for being with us today, and we'll see you on the next event. Bye-bye.
All right. Thank you all. Take care.